Kelly. Thanks so much for allowing me to be part of the podcast.
Most people speak on their throat.
I think you'd be a superstar in the banking industry.
We have not seen any dead bodies in the dumpster.
Tell us one of the dumbest, stupidest things you've ever done in your business career.
You have entered the world of accounting, the place where business dreams and financial reality collide into exciting things like journal entries, debits and credits, and financial statements. Everyday CPA Podcast, helping you and your business better compete, succeed, and win.
Good morning, everybody. This is Kelly Coughlin, CEO and CPA of EveryDay CPA, providing star services of strategy, tax, accounting, and risk management services to businesses and business owners. Today, I'm going to interview the CEO of a very interesting wealth management firm. He specializes in two primary areas: using alternative investments like real estate to complement a traditional portfolio of stocks, bonds, and cash. And the second is creating a traditional portfolio of stocks, bonds, and cash, but complementing that portfolio with what we call inverse correlated assets. An inverse correlation, also known as negative correlation, is a contrary relationship between two variables, so they move in opposite directions. Or, to put it simply, when one bucket of assets goes up in value, the other doesn't go up or doesn't go down. And when taken in combination, they together produce a good and reasonable rate of return. The popularity of this type of strategy has been growing substantially in the past 4 or 5 years. It's been used by institutional investors for many, many years. But on TV, you could see ads like crash-proof retirement, which at their core simply use insurance annuities to offload the risk to insurance companies. But then you also see guys like Ken Fisher saying, never, ever hold an annuity. It's no wonder that people are confused. But in steps my guest today, Kirk Chisholm, president of Innovative Wealth and Innovative Advisory Group. Kirk, how are you today?
Doing great, Kelly. Doing awesome on this wonderful Sunday morning.
Great. And we already discussed your kids are going to the water park?
Yes.
I've been to Kirk's swimming club in Boston area, and he has to pay a membership for that. And now his kids want to go out and spend another $50 today, right?
$50, Kelly. You don't live in the Boston area, do you? That would be nice if it was only $50. It's the cost of happy kids.
Kirk has a lovely wife that I've met, and I'm sure can't we just go to the club and it's right around the street, and you lose that argument, right?
Yes, every single time.
Great. Well, I've known Kirk for many years, folks, and his firm. And in fact, we liked each other so much, we decided to start working together. You might ask, why would an accounting firm do work with a wealth management firm? Sometimes people pit the two as arch enemies. Well, Kirk and I certainly are not. But here's how it fits into my company, EveryDay CPA. We do 4 primary things here. We call it our STAR services, STAR. Strategy, namely business strategy, tax, accounting, and risk management. And this work with Kirk and Innovative Wealth is the key element of the R component, the risk component of the STAR system. And the reason I'm doing this podcast now, today, at this moment, is because it's especially important. There are 2 things going on. Number 1, we are at some point in the continuum of the Trump rally. And 2, we have a presidential election coming up next year. First, the Trump rally. The market is up about 37% since Trump's election. I'll note that at this point in Obama's presidency, that is at this point in the number of days of his presidency, the market was up 52%. And ultimately, by the time he was out of office, the market was up 147%. Now, we all know the reason those numbers are so high for Obama. By the time Bush number 2 left office, the market had lost 26%. So he was at the very bottom of the market trough that he was able to creep our way out of. And of course, Bush suffered such poor performance because 9/11 occurred shortly after his election. We had wars in Afghanistan and Iraq. So anytime you have significant increases in the market, you also have an increased perception of risk that the market will give back some of those increases. So today, up 37%. Some of this fear is justified. Some of it's manufactured by annuity and insurance salespeople trying to use fear as a motivator to sell insurance products. These are the ads you see on TV. And Kirk and I, he doesn't know this yet, but we're going to have another podcast in a couple weeks where we're going to talk about these crash-proof retirement solutions. Because I'll go on record right now, that will be the next shoe to drop in the investment world. All of this nonsense that's being peddled on crash-proof, using annuities, etc., shoe's going to drop. And the second factor that's occurring here is the presidential election. There's no doubt in my mind that business owners across the board are fearful and nervous that if the Trump culture of reduced regulation, reduced taxes, pro-business mission and vision for America came to a screeching halt through an election, that nervousness and perception of risk would increase dramatically by business owners. And nervousness means business slow down in capital investments, slow down in new hires, slow down in new product innovations. And this means decline in markets, because the market's always about 3/4 forward looking. Now, would this perception of increased risk and a change in leadership at the White House be justified or not? It's a whole other question. I personally think it is, because I don't see any of Trump's competitors being pro-business. In fact, I see nothing but anti-business sentiment. So, Kirk, that's the background into which I'm going to launch our discussion today. Kirk Chisholm, president of Innovative Wealth Management and Innovative Advisory Group. I gave you a lot to think about in that intro, and here's where I'd like to start out. You've been doing this risk-managed portfolio stuff for many, many years. Why does your strategy work? Does it work? And what does the portfolio look like when it does work? What does it look like when it shines? That is, when the general markets are declining?
Yeah, I mean, those are some great questions, Kelly. And I want to start by putting a little background for my history, because I think that'll be helpful. So when I started in the industry back in 99, in December of 99, which of course was probably the worst time to start, right? You got off 2 decades of a bull market and then just started going into recession right away. So I learned risk management really quickly. You know, when everyone else was thinking the market was going to keep going up, and I didn't have that because I started with pretty much the market going down. So I learned real quick on how to manage money and how to manage risk in that kind of conditions. For me, that's why risk management has always been the top priority. Is rule number 1, don't lose money. I'll paraphrase Warren Buffett there. So we sailed through 2008 pretty easily unscathed, because we had some understanding of what was going on. And since then, we've built additional strategies to manage it even better. One of the things that I think people in the industry get caught up on is they come up with a strategy and they feel like, this is it. I'm going to do this, and this is going to solve all my problems. It's the best strategy I've ever seen, and it will never change. The problem is the market changes all the time. Every day, every second of the day, it changes. And the more computerization that comes into the market, the more rapidly that's going to change. So if you don't have agility, if you don't have the ability to change on a dime with your strategy, then you're going to get run over. I think this is one of the biggest challenges that we see, because when I got into the industry, you talked about earlier, Kelly, with inverse correlation or negative correlation. One of the things I found was initially you could diversify properly and it would work. And generally speaking, you know, when the markets go up, the diversified portfolio works as intended, typically. The markets go up about 66% of the time. When the market's going up, diversified strategies work. In 2008, in that period, it stopped working. It's fascinating, because we did some research way back to dig into this, and what we found was, if you looked at 2008, almost every single asset class except for cash and gold went down. When you study it, you say, how is that even possible? So we did some digging, and what we found was the net result was effectively that the institutions were causing the correlation, because all the big money was flooding into the market and making the same changes at the same time. So it caused effectively this correlation of assets. So it became really challenging to create a diversified portfolio to reduce risk. You used to be able to invest in things like Timberland and managed futures and hedge funds That used to allow you to diversify properly and get inverse correlations. The problem is because everyone was investing in the same thing, it was no longer non-correlated. It became correlated. Many people thought that they were diversifying and reducing the risk when essentially they weren't. And they didn't realize it because they were just accepting this norm as given. They're just saying, oh, this is the way things always are. They will always be this way. And it's not. Things change all the time. And if you're not assessing your assumptions at any given time, then you're going to get run over in this market because things change so rapidly. So that's kind of how I look at risk management. That's my background on it, why I look at things the way I do, which is a really important context, I think, for this conversation.
I gave a talk in London about 1 year before the Madoff hedge fund nightmare. I think that was in 2007. I was CEO of a financial technology investment firm. And the title of my talk was Hedge Funds Need TLC, Transparency, Liquidity, and Custody. And I'm not bragging here, but I guess I kind of am. That talk foreshadowed, I predicted this, it foreshadowed the issue that was highlighted by Madoff specifically and hedge funds in general. I think you'd agree that transparency, liquidity, and the issue with custody were core and critical to the problems Madoff scandal highlighted. Do you agree with that?
Yeah, I do. You weren't alone in your kind of assessment. I mean, our very own Harry Markopolos, who was kind of touted as one to find Bernie Madoff. He wasn't the only one. There were more, but no one listened because when times are going well, no one wants to pay attention to that stuff. They're not worried about it. It's only when times get bad that people worry. Well, it's too late, right? You have to, like you did, like you talked about it before it was a problem, and you need to have those kind of resources because when times go bad, it's too late. Everyone else is running for the door, and it's a lot harder to get out. Yeah,
this was at a hedge fund conference, and nobody wanted to talk to me at the cocktail hour after I said this. Like, okay, guys, well, I'm sorry. I didn't want to ruin the punch bowl, but transparency, liquidity, and custody. I want to clarify so listeners know why those are critical, because it's still true now. More than ever, investor on the transparency side. Investors need to see the underlying assets in the portfolio. And that's why I don't like annuities. You can't see anything. And then number two, investors need to be able to convert those assets that they do see for whatever reason. If they don't like what they see, they need to be able to convert them to cash or another asset. That's the liquidity portion. That's another reason why I don't like annuities. And then the third is custody. Ultimately, if you see something and you don't like it, you want to be able to access it. And if you've got some custodian that is non-existent, like we had with Madoff, where he was just fabricating third-party custody, you're going to have a problem. The reason I put custody at the end is because I like the TLC thing, but custody, in my mind, is kind of at the top of the list because you need to be able to see the assets at a qualified bank or broker, not in the file cabinet of some hedge fund manager that's acting as its custody. I'm assuming you're going to agree with all that stuff. I know you do because you operate your company with TLC. Tell me, how would you score you and your portfolio strategy in the TLC paradigm there?
Yeah, and you raise a great point, Kelly, because I think that each one of those components has an issue attributed to it in the markets in general, and some that I feel that we can kind of touch on here. But, with my portfolio, that's exactly what we designed it around. Transparency, liquidity, positions we have to be liquid, because if something happens and you need to get out right away. Actually, let's hit on custody first, because that actually will start this off. So we don't custody assets. We custody at one of the bigger custodians, which is TD Ameritrade. A firm like ours, we don't want custody. I don't want that liability. I would rather find a top-notch firm that does it really, really well and use them. And for us, TD Ameritrade was that good fit. So the transparency aspect goes along with that custody because we're not custodying it. The transparency is our clients can easily just go to the custodian. Like they get statements from the custodian. It doesn't come from us. They can always go on their account and see their investments in any given time. It's totally transparent. There's nothing hidden whatsoever about it. The liquidity of our positions is really important too. If you look at 2008, for example, and actually 2015, there was another example of this. So in 2008, in certain markets, there was a lack of liquidity. In the institutional markets, there were a lot of these vehicles that were created where there was a lack of liquidity at a time where people needed it most. So if I'm managing a portfolio, for example, and let's say I have 80% of my portfolio in the S&P 500, so a very liquid bunch of investments. Let's say 20% in some sort of a illiquid vehicle, some sort of institutional vehicle, and I want to liquidate that, but there's no liquidity. Now all of a sudden I have to start selling my S&P 500 shares because I need liquidity. I need to free up capital to either pay back investors or whatever it might be. So instead of selling the thing that I want to sell, I'm selling things I don't want to sell. But the problem is it's not just me. It's the entire market doing the same thing. So if you want to know why the assets correlate, it's because all these institutions own the same thing. So look at 2015 as an example. We started to see this idea, which I call contagion, which is effectively the oil prices started to plummet. Well, if you owned oil assets, you couldn't sell them because, no one wanted to buy them. They just kept going down. So in order to have liquidity in your portfolio, you sold something that wasn't oil. Maybe it was Apple stock, maybe it was real estate, maybe it was, in some cases, oil companies. The challenge is when everyone's trying to do the same thing at the same time, everything correlates and liquidity dries up. Now, for us, when we manage money, we do a lot with alternatives, but it's a very separate part of what we do. The traditional portfolio, which is kind of really what we're talking about here today, the traditional portfolio is fully liquid. We have set this up specifically for the fact that if people need liquidity, they can get it. Call me up tomorrow and say, hey, I need my money. I can just sell it, and it's done. Everything that we deal with is highly liquid. We only deal with the most liquid securities because of this very issue. When things go bad, liquidity dries up, you don't want to be on the other end of that. So that for us is extremely important.
Kirk, I know you like to work with CPAs and help them with their clients, just like you're helping me with my clients. Let's say I have some tax and accounting clients that need what I think is a risk managed portfolio. And the profile for that type of client is typically this. They've made their money, they've created their wealth, they don't need to hit any home runs, they don't even need to hit a triple, maybe a double, a single, they don't need to strike out, and they sure as hell don't need to be hit by the pitch. That's the typical client that that many of us see.
I like the analogy, Kelly.
Thanks. Number one, preserve what they have, and number two, grow it. In that order, what's the best way for these clients to work with you, whether it be a CPA or one of my clients? How are we going to work together on this? They're located in, say, Minneapolis and Kansas City. How do we work together?
First of all, location I don't find is all that important. I've been doing this for 20 years. Most of my career, I thought that I need to see somebody to work with them. But in the last 3 years, I've kind of changed that kind of mindset around myself. Because what I realized was clients don't want to see me. They don't want to drive an hour, a half hour to my office and then drive an hour, a half hour back. Like, it's much more efficient use of their time to just get on a call and talk about these things. You and I are in different states, and we work together just well. But the other part of what you're saying is very important. What you're talking about not hitting home runs and triples. There are many different types of clients. There are clients who are trying to build and grow their wealth, and there are clients who are not, right? They're just trying to maintain it or sustain their wealth. And, it's funny, no one sends you a letter and says, hey, you're rich, right? There's no letter that the IRS sends you that says, hey, you're rich, and now you got to start paying the rich person's taxes, right? It doesn't happen that way. There's kind of this gray area, depending on the amount of wealth that you have. You have enough, but you feel like you don't have enough. And it's weird. I've talked to people who are worth a couple 100,000, tens of millions. I've talked to people who are worth billions. And they all have the same mindset, which is, I need another 30% to feel comfortable. It's a weird human psyche that people can't be comfortable with the fact that the money they have is enough. So a lot of what we do with our clients is deep conversations on what I call the emotional side of money, which is, it's really important because let me give you an example. There's a woman I worked with for my entire career, a wonderful woman, and she worked really hard saving, and recently she got to a point where she wanted to retire. So she's going from this aspect of working hard and saving to no longer working and spending. That's a huge mental shift that people have to make, and it's really hard, right? You've spent 40 years working and saving, and now you just have to flip the switch and do the opposite. That's very uncomfortable for people. It's not an easy transition to make. So a lot of what we do is helping people with, I guess, what I would call retirement lifestyle planning, which is helping them make that transition so that it's not just that they have enough money, but it's that they're comfortable with the money that they have and they're comfortable spending it. Because I work with a lot of people who have way more than they need and they feel like they don't have enough. This woman, for an example, she was actually spending less than she was making in Social Security. And she's worth 7 figures easy. There was no way she would ever run out of money at that spend rate. And what I was helping her do was be comfortable with the fact that she had enough money and be comfortable with spending that money. You spend your whole life saving this money, like you need to enjoy it. Like retirement's about, we call it phase 2 of your life, because you've got another 30, 40 years when you retire. What are you going to do? Sit around and golf all day and drink beers? I mean, that's fun, but that's not the purpose. And a lot of people need to rediscover that purpose when they retire because they make such big shifts. Getting back to the point, when I work with clients, I'll tell them up front, our job is not to hit you home run. Our job is not to beat the S&P every year. Our job is to hit the singles and doubles, to get, good performance. But the real key to what we do is not lose when the markets hit a recession. That's really the key, because if you don't lose when the big losses come, then you're way ahead of the game. In 2008, from the peak to the trough, the markets went down over 50%. If you didn't lose 50% in those years and you were in cash, you effectively made 100% return on your money. Because not only did you not lose money, but you could have bought everything 50% cheaper. So effectively, you just made 100% return on your money. And you didn't have to do anything. You didn't have to outperform the index. You just had to sit on the sidelines and not lose money when everyone else was losing money. It's a different perspective than I think most people make, but if you consider where we are in the economy right now, we've had 10 plus years of a bull market, close to 11 years of a bull market. We're getting to a point where a recession could come at some point in time soon. It could happen next week. It could happen 5 years from now, right? No one knows. No one can predict the future. But I don't need to predict the future to know how to handle this situation. What I need to know is that there is a recession coming at some point. We all kind of feel that. It feels like everything's really expensive, and it is. And at some point, we're going to have a recession. That's inevitable. That's just the way that market cycles work. My role is not to know when that's going to happen. My role is to predict that the market could continue to go up, and also the market could easily go down. So we've built a strategy around that process, that if the markets are going up, you make money, and if the markets melt down, you're not losing money. That's really effectively what we've done. With our approach to investment management, we look at the situation that we're in, which is the markets could go up or they could go down, and we build a strategy around that.
Kirk, here's how I see it. Certainly correct me if you find it flawed. Historically, you have the CPA that's more or less pitted against the financial advisor. The advisor is always recommending more risk, and the CPA is saying less risk. And the CPA tends to say no to anything that is unpredictable or about which he or she is either not educated or experienced in. As of, I'd say, the last 10 years, I think, many CPAs have decided that they're going to get into the advice business. They're going to open up advisory practices and become financial advisors, become wealth managers. I kind of fundamentally disagree with that, because the objective supervisory role, to stick with the baseball metaphor, the manager role of the team, is now merged with the player, or merged as a player. And I think the CPA is best sticking with the manager role, but becoming a better manager so that he or she is a little more educated and experienced in it. So it's not just no to everything. But the CPA should stick with the manager role, the supervisory role, but review the performance of the players. That could be a large cap player. It could be a wealth management player. It could be a small cap, could be an alternative, or it could be review the performance of a wealth management player like yourself, who looks at all those underlying asset classes, small cap, large cap, alternatives. Do you agree with that analysis? Does that make sense to you?
It makes total sense, Kelly, and you're 100% right. So if you look at the traditional CPA role, it's accounting and tax, risk management strategy, tax planning. Like there's a lot of things that the accountants bring to the table. And you accurately pointed out, I've seen this where a number of them will try to become wealth managers or financial advisors. And they're putting themselves in a very precarious place because I've been doing this for 20 years. I'm always learning new things. This is a profession in of itself. For an accountant to all of a sudden start providing wealth management services or investment advice or all the things that we do, it would be like me going out and saying, I'm going to be an attorney. It's a totally different profession and requires a lot of time, effort, study. Like it's not just like, oh, I'm just going to go make money off mutual funds for providing to clients. The CPAs are much more into risk management, which I think is a really good position to be because you're one of the most trusted people in the client's lives for anything that affects them financially. You need to have that oversight and guidance. You need to have that supervisory or managerial control, to continue the analogy. You need to have that oversight because the clients want that. The clients are asking for that. And you'd be in a much better place providing that position than to actually doing the investments yourself. Because you're taking a step back and you're being an unbiased third party and saying, here's what I think we should do. As you mentioned, I do work with a number of CPAs. Our strategy is more tactical. And we've done this specifically because of the nature of what you're saying, which is as a CPA, it's your job to provide oversight and guidance. And you don't want the clients to lose money. So our strategy in many ways has been developed around that philosophy, which happens to coincide with my philosophy anyway, which is rule number 1, don't lose money. Rule number 2, pay attention to rule number 1. Like making money is the easy part. That's going to happen. It's the risk management that's the hard part. And that's the thing, if you don't get it right, you can really screw up your portfolio. So it's really important to get the risk management right first. It's your obligation as the supervisory role. It's very important to take care of this for your clients because they look to you as somebody in this role. And our society, we're lacking leadership in our society. And I really appreciate the fact that you've kind of taken this role head on and saying, I'm going to do this for my clients because it's really important to provide this service where other people are not doing it.
Yeah, it's kind of like CPAs, let's say tax-focused CPAs. We scratch and claw and fight to help clients get a extra $100 refund or minimize their tax by $200. That sort of thing. Maybe it's even in the thousands. But it's kind of like when we stay out of the wealth management area where we're not helping on the risk management part of their wealth, what are we doing? I mean, we're winning these tiny little, I wouldn't even call them battles, I'd call them skirmishes. We're winning those little skirmishes, but the entire war is being won and lost and fought, and we're not even participating in it. It's almost like CPAs are afraid to get into the arena, afraid to fight, afraid they'll get shot, so they hide in their tent. I don't know. I'm mixing a whole bunch of metaphors now. But
yeah, and I think your point's valid because I think the CPAs we work with, we tend to work with them on a collaborative basis. And I think one of the challenges is, and this is not just CPAs and advisors, this is all service professionals. When we work with our clients, we work with CPAs, we work with attorneys, we work with various different professionals. And what I find is common in our industry is that, like, let's just say an advisor says, hey, you should do some estate planning. And, either the client has somebody they work with or the advisor finds them someone. And then they do the work and they put all this package together. They spend, a few $1,000s and they have this package and the attorney's like, great, you're all set. And the client's thinking, hey, I'm all set. Well, what he really meant was, here's your package. You figure out the rest of it. And the client thinks they're fine, so they don't say anything. And, they set up trusts or whatever they're doing, and they don't get funded, get set up properly. So all of a sudden, you just spend a lot of money for something that isn't even implemented. And no one knows because it's this, like, one hand doesn't know what the other hand's doing. So what I find is most effective is working with people on a collaborative basis. So, for instance, you and I would talk about each client and say, all right, we're going to sit down and work with this client. Like, let's figure out, what kind of tax planning they need, what kind of cash flow management they need. What about their investments? What about their estate? And we look through each of these quadrants of the puzzle and say, what needs to be done? How can we coordinate this? Because we do operate on different playing fields for that because we're doing different things. So it's important that this kind of collaborative method works well so that the balls don't get dropped, things don't slip through the cracks, and that everything is getting taken care of. So from a client perspective, you're getting a much more holistic perspective of oversight and guidance, and you're really getting taken care of from different angles from people who have different expertise. So what I find is if people are trying to do everything themselves, as you said, the player versus the supervisor, it's really hard to do everything yourself well. It's a challenge finding good professionals that are collaborative, that want to work together and are not territorial. So I think you kind of hit the nail on the head there, and that's one of the reasons why we're working together is because, we both see that element of collaboration as being very important for the client and really doing what's in the client's best interest, which I think is the top priority of any relationship.
Yeah, I think this is a good model. I like it. Anyway, we can terminate it now so you can get back to going to the pool or using this podcast as an excuse to not have to go to the water park, the urine-filled water park.
Lots of chlorine, Kelly. Lots of chlorine.
All right, Kirk. Enjoyed it. Take care of yourself. How should people get in touch with you if need be?
Yeah, I'm pretty easy to find. You can find me at innovativewealth.com. So our website, innovativewealth.com, you can come there. I've written pretty much everything on the website. I've written myself, a lot of the blog posts if you want to get to know about me. You can find me in all the social media channels. I'm really pretty easy to find. And obviously you can find me through Kelly because Kelly and I are working together. So the other path is contact Kelly and he and I can coordinate working with you as well.
Okay, Kirk. Enjoy the remainder of the weekend. Take care of yourself.
All right. Thanks. Thanks a lot, Kelly. Thanks for having me on.
Thank you so much, Kelly, for having me. I really appreciate it.
Kelly, thank you very much.
Thank you, Kelly. We'll talk soon.
Thanks for tuning in to the Everyday CPA podcast. We will see you next time.